back. We are back with Martin Pelletier, Senior Portfolio Manager at Wellington Altus Private Wealth, this time to talk about where he thinks investors should be positioned in 2025. Martin, thanks for sticking with us. We fixed our audio connection to you. The question you didn't hear me ask properly was that you have said in some recent commentary you worry investors have been turned into speculators, and as an example, you pointed to a couple of new or pending ETFs in the United States. Why don't we start there in this conversation?
Yeah, and so when the ducks are quacking, you have to feed them, and institutions are all happy to do so. ProShares filed for ETF on the S&P and NASDAQ 100 ETFs. They're going to be dominated in Bitcoin. And so that means they're going to have a long position in underlying tech stocks or dominating tech stocks, backstopped by a short US dollar and long Bitcoin position. And Bitcoin, in my opinion, looking at the data itself, is a levered beta play. So what I mean by that is it'll do 2 to 3 times what the market does. And so as long as the market continues to move higher and liquidity continues to go in the market, Bitcoin will do very well. And so this will add a lot of risk into portfolios. If you look at the S&P, it's very highly concentrated. You have 40% of the index dominated by 10 stocks. And so now you're adding a lever component with Bitcoin being priced in Bitcoin. So that's just going to add a lot more risk into portfolios as investors try and juice up their returns to maybe make up for what they missed last year or 2024.
Okay, let's go now to how you think investors should be positioned in 2025. Unlike a lot of people in your industry, you think investors should be defensively positioned in 2025.
I do. I'm going to make the call. I'm probably the last great bear, David Rosenberg, capitulated at the end of this year. So to me, that's a sign of maybe it's time to take a little bit of money off the table. And maybe that's going to be a pervasive thought in January. People don't want to take their tax gains and lock it in for the whole year. They'd like to get the tax deferral. And so maybe we start to see some of that happen in January of 2025. There's been some really good gains in the markets. And so if you could take some of that money off the table of the last gains made over the last 2 years and redeploy, diversify, rebalance your portfolio instead of going all in and adding more leverage upside is probably not a bad strategy. And so what I mean by defensive is, hey, look at some of the other components, S&P 490, for example. Try and find some value there. Try and find some companies that are going to generate some nice free cash flow. And where are the opportunities there? And so, for example, we like the utility sector, specifically the Canadian utility sector, generating some really good dividends. Interest rates are going to fall faster in Canada than in the U.S., so they'll benefit from that with their balance sheets and their reduced debt exposure. And so, targeting an 8 to 10% return for 2025 in those kinds of segments of the market is not a bad strategy, in my opinion.
You also like structured notes.
Yeah, and so we're placing almost 100% of our positions within registered accounts because they are taxed as income, unfortunately, within structured product. Structured product's really good because it provides some downside protection. So you could take some money off the table on your equity, especially if you have it in your TFSA or RRSP. It's a no-brainer to take some money off the table and diversify into maybe a structured product where you can still participate in the market but have built-in downside. So, for example, we've done some principal protected notes that will track the market 3 times to the upside with full downside protection over the next 3 years, 3 to 5 years. We've done ones that will pay, interest coupons 8 to 10% with 30 to 35% downside risk. And so it just allows you to sleep at night knowing that you don't have to rely on the Fed to juice up your portfolio to get the same to get some double-digit returns when you can do so safely within other areas of the market.
To what degree is gold represented or included in your client portfolios? One of the big stories in 2024 was the huge rally in gold, which has stalled since the end of October. We've seen gold flatline and come down a bit from record highs. What's your view on gold in 2025, and are you exposed on behalf of clients?
I wish I was exposed as much as what, given what's happened in the market the last 2 years here. Gold's been an excellent trade. This last 2024 has performed as well as the S&P 500. Gold has been a really tough one for us to get our head around. At first, it had an inverse correlation with the U.S. dollar, and then that unwound. It moved higher with the U.S. dollar. If you look at what's happening abroad, central banks and emerging market central banks have been big supporters of gold. China just came back into the market buying gold in December after a 6-month hiatus. And so will these emerging market central banks continue to buy gold? And gold has been a good hedge against the money supply increase and inflationary hedge. And so the big question is are we going to see the resurgence of inflation? Maybe we will with some of the Trump policies. And so I personally think gold's going to be range bound for the next couple of months. And maybe that provides an opportunity to get a better visibility as to where the outlook looks, where the outlook is going to lie ahead with the U.S. economy, interest rates, and emerging markets. Emerging markets, a little bit of trouble here, especially in China. The Chinese debt yield is now lower than Japan, which is kind of crazy. And so are central banks those central banks in particular, going to continue to support gold? That's a big question mark that I don't know. But is it worth having some gold in your portfolio? Probably yes.
What is your view of the Canadian stock market, absent the utilities and infrastructure sectors that you've already spoken about?
I think it's very important to there's a great saying that economies and stocks don't always move together. I am bearish on the Canadian economy, unfortunately, certainly compared to the U.S. economy. Having said that, we are in a very protected market environment, not a lot of growth, but a lot of protection in regards to the oligopoly structures within Canada, and so you'll see cost savings being passed along in regards to protection of existing dividend payouts. And so I look at that as being an attractive sector to be in, albeit with a Canadian dollar doesn't look very exciting, especially with a lot of our friends and colleagues that are traveling south of the border with 69 cents. If putting that aside, the Canadian market looks to be a good one to own in 2025. Energy dominates. Energy has been underperforming more recently, but the free cash flow is being generated from that segment. And if you think that, as I mentioned, the Canadian dollar is going to stay where it's at, these Canadian oil companies are getting paid in U.S. dollars, which many people forget. And so you're getting some really nice currency exposure and free cash flow there, assuming OPEC continues to do what they're doing, and I think they will.
Martin, thanks a great deal for these conversations. Have a happy new year, and we look forward to speaking to you early in 2025.